Hey everyone, welcome back to the channel. This is LC. We will focus on how a quick analysis of ROIC indicates whether a company has a competitive advantage. If so, what lies at the foundation of that advantage? There are two sources of competitive advantage: consumer advantage and production advantage. The key to each advantage is the creation of barriers to entry that fend off competition. Barriers to entry are particularly strong when a company enjoys economies of scale, which mean the cost per unit for the incumbent is lower than that for a challenger. A consumer advantage is the result of the habitual use of a product, high cost of switching to a new product, or high cost of searching for a superior product. A production advantage allows a company to deliver its goods or services more cheaply than its competitors, either as a result of privileged access to inputs or to proprietary technology that is difficult or costly to imitate. ROIC can provide a quick and useful way to guide this analysis. The first step is to recognize that ROIC can be decomposed into two parts. This is a modified version of what is known as a DuPont analysis of ROE, the ratio of NOPAT over revenue, or NOPAT margin is a measure of profit per unit. Revenue over invested capital or invested capital turnover is a measure of capital efficiency. When you multiply the terms, revenue cancels out and you are left with NOPAT invested capital or ROIC. It is easy to imagine two companies arriving at the same ROIC via different paths. A low-cost retailer, for example, may get to a 20% ROIC via a 4% NOPAT over sales ratio and a 5 times sales over invested capital ratio. The classic low margin, high invested capital turnover business. A luxury goods seller, on the other hand, may reach the same ROIC with a 20% NOPAT over sales ratio and 1 times invested capital turnover. That's all for this video. If you enjoyed the video, give me a like and share it out. If you didn't, a dislike. Subscribe for more, ring the bell, and I will see you in the next one.